Good afternoon, everyone. I'm Ali Simpkins, and I'm the local fund specialist at Momentum Investments. I'd like to take this opportunity to thank you for your time and welcome you to our local masterclass session today. In today's session, Herman van Papendorp, who's the head of our macroeconomic research, will take us through how to navigate various asset classes through turbulent times, similar to what we're currently experiencing. As a friendly reminder, I'd like to make you aware that you can pop your comments or questions in the Q&A section, and we will address these questions throughout the presentation or in our Q&A session at the very end. So with that, a little reminder, I'd like to hand over to Herman. I hope that you all enjoy the session this afternoon.
Thanks very much, Ali. Nice to be here. Thank you, everyone. Nice to be with you on a nice afternoon. Some rainy weather up here in Gauteng. I don't know how it's across the country, but I hope you've got good weather where you are as well. I'm going to share my screen and then we can get rolling. Right. Now, I'm going to talk a little bit about asset allocation today, very much looking at the different asset classes that we invest in at Momentum Investments. You will see that reflected right throughout our portfolio positionings. So without further ado, just looking at some of the things that I will be talking about. First, looking at some of the global asset classes. We'll talk about some of the fundamentals and some of the valuations on global equities and global bonds. Then delve into the local asset classes, where we'll look at the fundamentals and valuations on South African equities, South African fixed income, and also South African listed property. And right at the end, what I will do is I will put all of this together and give you our asset class return expectations, but more importantly, our views on how one should be positioned in the different asset classes. Because obviously we don't invest just on the basis of what we think returns could be, because that's very much an unknown. We try and gauge a range of returns that could be probable for each of these asset classes. But then more importantly, we put our risk hat on and we look at the risk return ratio for each of these asset classes. And that's how we construct our portfolios in Momentum Investments. But without further ado, let me talk about global equities and global bonds. Quite an interesting time. Obviously, we've had this year quite a bear market in both the global equities as well as global bonds. And we have to say that the underlying fundamentals for global equities are still not looking fantastic. We've got an environment where we see peaking inflation globally. That's obviously taking away some of the pricing power of companies. We have a slowing economy, so that means that there's less demand for corporate products out there globally. So the combination of lower prices, less volumes, obviously top line growth then for global companies very much under pressure. And over and above that, we still have significantly high wage growth internationally, which is obviously a big cost element for all of these companies. So that erodes margins and erodes profits. So not only is the revenue line under pressure, but the margins and therefore also the profit line very much under pressure for global corporates and therefore for global equities. And the interesting thing is that even though we're seeing this kind of macro environment unfolding globally, which is not a great one for equities, we haven't seen earnings revisions being adjusted downwards significantly for global corporates and for global companies. So you have this mismatch between what the macro is telling you that says, well, be a little bit careful about the profit growth outlook for companies, and what the analysts are saying with their earnings forecast at the moment. So they are still too bullish on their earnings forecast. So with this mismatch, we think there is still some downside risk for the equity asset class. We also will talk a little bit about quantitative easing and quantitative tightening. Quantitative tightening, the operative word at the moment, because we are going now into an environment where global central banks are starting to bring down their balance sheets that they've built up since the global financial crisis through quantitative easing. They're now going to the reverse of that. Quantitative easing was a very big support for global equities over the last decade and a half. And now when we see the reverse, one can only say, well, this is now probably going to go from a tailwind for equities to a bit of a headwind for equities over the next year or two. We'll talk a little bit about recession globally, because it does matter. A recession kind of environment, rather than just a pure growth slowdown, is much more negative for equity markets, much more downside risk for equity markets in a recessionary environment than in a non-recessionary environment. We also will make the point really that risky assets like equities normally don't bottom in an environment where recession hasn't started yet. We have to see a recession start before we start getting an indication that the markets are starting to discount, that central banks will start cutting rates again somewhere along the line to obviously push back against the recessionary conditions. So you don't really see risky assets bottom before you actually start seeing the anticipation of interest rate cuts happening. And that normally is happening when recessions really start. They don't really, markets don't bottom before recessions start. They need to see a recession first, and then markets will likely bottom. So we haven't seen a recession as yet in the US. So again, saying to us that maybe there's still a number of quarters of downside risk for global equities in the offering for investors. We have an environment where, a lot of people are starting to wonder whether the Fed is going to pivot from this tightening interest rate environment to much more of an interest rate cut environment. That is still some way off. I think we can't really look at a pivot for the Fed until inflation really is meaningfully and sustainably lower, at a lower level. And for that to happen, you need wage growth, which is a big factor that actually drives inflation at the moment at high levels, until those wage growth levels start coming down, and that'll probably not happen before unemployment doesn't rise in the global environment. Bond valuations, they're still looking expensive on their own, but they're now looking a good side better relative to equities. For the best part of 10, 15 years, we've actually seen equities looking much more favorable from a valuation perspective than bonds. But that has now started to reverse, because bonds have sold off so much that even with equity markets also selling off, the bond market sell-off has just been so much more that you're now starting to see that bonds start offering value for us globally as an asset class relative to equities, whereas for the last 15 years, we've basically said there's actually only a one-way ticket, and that is to be invested in equities globally and not in bonds. Let's look at the underlying fundamentals as I've described them. So first, let's look at the top line growth. So that's the sales growth line of corporates globally, and in this case now specifically the US. What I've got here is just a normal regression looking at the amount of the top line growth of the US market that's really driven by different macro variables. So firstly, if you look at how much of those sales growth numbers for the last 60 years or so, how much of that has been driven by just inflation? You can say about 20% of sales growth driven by inflation. About 25% of sales growth driven by just what's happening in the real economy, so real GDP, economic growth. And then if you put the two together into nominal growth, we say, well, almost half of the change in sales growth over the last 60 years could be determined by what was happening to nominal GDP growth. Now, I've said a little bit earlier that our anticipation is that nominal GDP is going to start coming off with the economy slowing down, so that real GDP number coming off, as well as inflation peaking and starting to come off into 2023. The combination of those two will bring nominal GDP down, will therefore bring sales growth down, a fundamental negative for global equities. And over and above that, we also have more pressure on margins. Because even if you think that the nominal GDP, which is depicted on the top end graph here by the blue line, if you think nominal GDP is going to come down, and you don't think that the yellow line, which is wage growth, is going to come down as much, then you will see that the margins, or the proxy for margins here in the black line, is likely to come down quite severely. So in that scenario, we have not only sales growth, as I've shown in the previous slide, coming off, but also margins under pressure and therefore profit growth under pressure. And again, the interesting thing here is that the proxy from a macro perspective for margin is showing us that margins are likely to contract over the course of the next 12, 18 months in the black line here. But analysts are not foreseeing this. If you look at the blue line on the bottom graph, you will see that analysts are still looking for margins to go up. So there again is this huge discrepancy in the market between the expectations for margins to still go up, but the macro is telling us that the margins are likely to come down. So again, that tells you that there could be downside surprises for the market, global equities, as the macro unfolds over the next 12 to 18 months. Also, I mean, if you look at just the overall earnings expectations, the bottom-up consensus on the S&P 500, the US equity market, you can see it's barely begun to start drifting off. So analysts are not factoring in the fact that the macro environment is telling us that there will be a deceleration in earnings growth over the next 12 to 18 months in the US and also in the global equity markets. Analysts are not factoring that in yet, so they will do that probably over the next couple of quarters. So a lot of negative surprises probably coming through for earnings expectations in the global equity market into 2023. Let's talk a little bit about quantitative easing, quantitative tightening. Quantitative easing, a massive tailwind for equity market returns over the last 10, 15 years. Quite an interesting study if you look at, again, how much of the total return in the US equity market could be explained by earnings before the global financial crisis of 2008 and after the global financial crisis since 2009. And quite interesting, before the global financial crisis, about half of the returns of the US equity market could be ascribed to what happened to earnings. So you just needed to get a good grip on what you think earnings was going to do in the US, and therefore you would have a good grip on what the total returns will be in the US equity market. But it's quite interesting what's happened on the left-hand side, the right-hand bar here of this graph. After the global financial crisis, you can see that only 23% of the total returns of the US equity market could be ascribed to what happened to earnings. So there was a bigger part of the return profile of US equities that came from somewhere else. And that somewhere else was what happened to QE, or the balance sheets of central banks, in this case now in the US, the Federal Reserve. So again, before the global financial crisis, there was no QE. So QE had zero implication for what happened to total returns of the US equity market. But you can see here, since 2010, we've had almost half of the non-earnings part of the total returns that could be determined by what happened to the balance sheet of the Federal Reserve, what happened to QE. So 39% of total returns came just from QE. Now, again, as I said earlier, we're now going from a position where up to last year we had QE. Now we're going into a QT, quantitative tightening, where the central banks will be selling assets, not buying assets. So again, you'll have to say, well, you can't just have your cake and eat it on the one side. If we're going to see a reversal of this, you have to say, well, then quantitative tightening will put a damper on the kind of returns one can expect from the US equity market, in this case specifically. Let's talk a little bit about the Fed pivot, because that is very much a talking point at the moment in markets globally, to say that, you know, if the Fed's going to start moving away from hiking interest rates to probably cutting interest rates somewhere along the line, so they pivot from tightening to more of an easing monetary policy framework, then surely that should be a positive for equity markets. Well, the problem is just that the Fed is likely to be far away from actually pivoting to that lower interest rate kind of environment. It's probably going to only happen somewhere towards the middle of next year that the markets are going to start thinking about the Fed probably cutting at the earliest, probably late next year, so 12 months from now. And why is that? Well, inflation is still too high. We have this inflation problem still globally. In the case of the US, goods inflation has already started coming down, but the services inflation, which is the biggest part of inflation in the US, has remained very much at very high levels. You can see here CPI and services inflation on the left-hand side of this graph. That's the black line. You can see red off the left axis. More than 6% services inflation at the moment in the US. Now, when there's 6% services inflation in the US, the Fed is not going to start cutting rates. They're not even going to start thinking about cutting rates. So in this kind of environment, one has to look at what are the drivers for services inflation? What can bring service inflation down? And the first big cost element of service inflation is very much wage growth. You can see what is happening to wages at the moment in the US is that wages are running at 6.5% year on year on this Atlanta Fed wage growth tracker. So again, at 6.5% wage growth with CPI services inflation roughly around the same kind of levels, you will need wage growth to start coming down before we're going to see services inflation coming down, and therefore the Fed becoming more comfortable to start thinking about moving away from a tightening interest rate cycle eventually to a loosening interest rate cycle. On the right-hand side, again, what will bring wages down? Well, there's such a tight labor market at the moment. There's very little supply of labor, and there's a lot of demand for labor at the moment. So you'll actually have to change that dynamic between supply and demand of labor. And how do you do that? Well, you can bring more supply of labor in if you increase the unemployment rate in the US. Now, again, if you look at the unemployment rate, the black line on the right-hand side here, unemployment at the moment, historical lows of 3.5%. Only 3.5% unemployment in the US. Now, our best estimate is that 3.5% will probably have to go to 5 to 5.5%. So a 5 handle on unemployment before you're going to start seeing the Fed becoming more comfortable that the service inflation is going to start coming off because wage growth will then be under some downward pressure. If you have unemployment rising from 3.5% to 5.5%, you're probably going to see wage growth then, falling from, let's call it 6.5% at the moment to somewhere around 3 to 3.5%. And in that kind of environment, this is an environment which will really give the Fed more comfort that inflation has peaked, inflation is coming off because wage growth is starting to cool off, and therefore they will feel more comfortable in actually starting to think about ending the tightening cycle first, then pausing, and eventually then starting to think about cutting interest rates, maybe late next year or into 2024. It's important whether we are going to see a recession in the US or not. You might say, well, what's as much of a muchness? If there's a slowdown is a slowdown. Well, it depends on how severe that slowdown is for how markets will react. And I've got some interesting statistics here to show that, for instance, in the US equity market, if you have got a non-recessionary environment, the drawdowns during a non-recessionary slowdown in the US is roughly around 15%. But in a recessionary environment, it's 3 times higher. It's around 35%. So 2.5 times higher is the drawdown magnitude. So the magnitude of a drawdown during a recession is 2.5 times more than in a non-recessionary kind of environment. But not only that, it's also the duration of that drawdown that's much longer in a recessionary kind of environment. Again, if you look at the US here, we can say that it's about roughly 100 days from peak to trough in a non-recessionary slowdown in the US for the US equity market to go from peak to trough. But if you look at a recessionary environment, you can see that's 4 times longer. It takes 400 days roughly between peak to trough in a recessionary kind of environment for the market to bottom. So again, it tells you that if we're not going to see a recession in the US, then one can start thinking about, a bottoming equity market. However, if we're going to see a recession, we are still long before we're going to start talking about a bottoming in the US equity market. It's probably going to happen only towards the middle of next year, if you look at these kind of 400 trading days on that environment. Relative valuations, I said to you earlier that, the relative valuations have been stacked in favor of equities against bonds globally for, the better part of the last 15 years since the global financial crisis. I show this. We've got an earnings yield. So that's the inverse of the PE of the US equity market relative to the 10-year bond yield here. And on the left-hand side, it's just on trailing earnings. You will see here If the line is below the average, the red line is below the black horizontal average, then that was an environment where equities was much more favorably valued relative to bonds. You can see this has been the case since the global financial crisis over the last 15 years. Now what's happened on the trailing earnings yield gap basis, we are now going back to around the average level. So we can say, well, yeah, from equities being cheaply valued relative to bonds on this specific valuation metric, it's now fairly valued. There's another way of looking at it. If you don't want to look at just trailing earnings, so the last 12 months earnings, but you look through the cycle earnings, so the last 10 years earnings, and you do the same kind of exercise, again, you get the same kind of indication that for the last 15 years, on a normalized earnings yield gap basis, equities were significantly better valued than bonds for the last 15 years. So no surprise that probably a lot of asset allocators like ourselves, we've been saying consistently for the last decade that you wanted to be in equities, you don't want to be in global bonds. But what's happened now is that global bond yields have risen so significantly that on a normalized earnings yield gap basis, equities are now starting to look expensive relative to bonds on a normalized earnings yield gap basis. So we say, well, at least bonds are not expensive anymore relative to equities. They're either fairly valued or they're now cheap. So we start looking at bonds as an asset alternative internationally as well. It's not only the TINA concept. There is no alternative. You have to be in equities. Not so anymore. Interest rates have gone up significantly. Short end of the yield curve on the cash side. I mean, cash at the moment gives you roughly around 3.5%, 4% in the US. So again, earnings yield on the S&P 500, roughly 5. So that gap has closed significantly. Bond yields, 10-year yields, roughly around 4. Earnings yield, roughly around 5. So that gap's only 1% where it was significantly when bond yields were 0 and 0.5% about 2 years ago. You had this significant discrepancy between the relative valuation. Not so anymore. In an environment where we're a little bit worried about equity markets that have further drawdown potential, further downside, we think that bonds will actually, global bonds, not such a bad asset class to go and park your offshore cash in at the moment. That's the global equity bond scenario. Now, obviously, South African equities is the one we want to talk about now because it's very much closely related to what will happen globally. So obviously, if there's still drawdown potential globally, there is also still drawdown potential for South African equities as well, because you have an environment where obviously all risky assets might be under some downward pressure until the market globally starts thinking about a cutting interest rate cycle in the US. And that, as I said, is probably not going to happen before roughly the middle of next year. So for the next 6 to 9 months, we're probably going to have an environment where still risk off is still very much the name of the game, and South African equities will have those same kind of drawdowns that we will experience internationally. But the big positive for South African equities is that equities in SA is very cheap. The relative valuations to emerging market equities, the relative valuation to developed market equities, very cheap on historical low kind of levels. So that will probably mean that your downside risk during a drawdown phase will be less, and your recovery potential in the up phase after you've seen markets bottom or trough somewhere in 2023 is probably going to be significantly more because you're buying at a much cheaper, or you have a much cheaper valuation on SA equity than on global equity. So these kind of factors are the ones that we try to gauge on and on when we look at South African equities. And we try and be conservative, and we still get significant upside potential for SA equities. The one worry factor is obviously if in a global slowdown, global growth coming off, demand for commodities cooling off somewhat, that is going to be a downside risk for South Africa, because South Africa is still very much a market that's linked to commodities. So that's why you have this year-on-year growth in the all share, very much closely correlated with the year-on-year growth in commodity prices like the metals index. So from that perspective, it's something that we monitor all the time and say, well, we're probably going to see some downside risk for earnings in South African companies, but also some downside risk potentially for share prices during a drawdown phase as potentially the US and the global economy goes into either a mild recession or a bit more of a moderate kind of recession. But the valuation picture is a positive one, as I said. If you look at here, South African forward PE on the left-hand side relative to emerging markets forward PE, you will see that historically, and this is roughly just starting this time horizon, just before the global financial crisis, you'll see the dark blue line. That shows that South Africa has been trading above the 1 level for the dominant time period since 2006, roughly up to 2019, just before COVID. So we've been trading at a premium on our forward PE, SA versus emerging markets. But what's happened since COVID is we've actually started trading at a consistent discount to emerging markets. We're now looking very favorably valued to other emerging markets out there on the forward PE basis. If you look at emerging market forward PEs relative to developed market forward PEs, you can see, well, yeah, emerging markets always trade at a discount. You can see it's below 1. So the forward PE multiple is below 1, the relative to developed markets. So EM always trades at a discount to DM, but the discount is now at historically low levels. Again, EM looks very cheap to DM. South Africa looks very cheap to EM. So South Africa is massively cheap relative to developed market equities on the equity market side. If you look at South African forward PE just in its past history, I do sort of ignore a bit longer term history, but if you look at what's happened here since the emerging market crisis of 1998, that's really the time horizon that I think is the relevant one. So roughly speaking, the last 20, 25 years, you will see that we're now trading at a 10.8 times forward multiple on a very conservative earnings base. If you look at consensus earnings in South Africa, the consensus earnings are in double digits. I'm worried about the commodity price impact of maybe commodity prices slowing down, and therefore I watered down the consensus earnings number somewhat. I say, well, we're not going to get 10 or 12% earnings growth in the next 12 months, more likely to have 6. So it's a very conservative assumption. But even on that conservative assumption, you'll see the forward PE is back at levels at the global financial crisis. And South African equities did phenomenally well after the global financial crisis because of the fact that you bought in at a very low level. So again, saying that even taking conservative assumptions into the equation, the South African equity market is deeply valued. You might find some other commentators say, well, we're now in single-digit territory on a forward multiple. And that's because they use the consensus earnings numbers of 10, 12%. I say, well, I don't even need 10 to 12%. I can just use 6%, very conservative, and still get a very good upside potential for South African equities from these kind of levels. So again, making the point to say that, yes, we were not going to be left alone if you have drawdowns globally in global equity markets. South African equity market will go down with it, but probably go down less because it's an environment where our valuations are much more attractive. And then when the recovery happens, our recovery is going to shoot the lights out on SA equity relative to global equity because our valuations, again, are so much more positive. We've actually seen most of that this year as well. I mean, I just had a look this morning. The US equity market, for instance, down roughly 19% from its peak year to date. South African market is down 9%. So 10% better. We've outperformed US equity market by 10% this year. I think this is going to be the name of the game for the next couple of years because of this very positive valuation story. Let's talk about South African fixed income. If you look at South African fixed income, I think the big positive there is that the real yield story is a good one for SA equity. We're looking favorably valued on real yields to developed markets because developed market yields in real terms are negative because they've got high inflation and their real and their nominal bond yields are lower than the inflation. So they've got negative real bond yields. And we're also looking very favorable relative to emerging markets. We have one of the highest emerging market real bond yields out there in the emerging world. So again, SA is looking attractive. SA is also looking attractive relative to its own history. We'll talk a little bit about not only nominal bonds, but also inflation-linked bonds, because the real bonds, they also look quite interesting and attractive at the moment. The only problem for them is we probably have already moved beyond the peak of South African inflation. So South African inflation is probably going to come down somewhat. So that erodes a little bit of the return potential of inflation linkers, but it's still one that we want to be overweight in. We'll rather want to be more overweight in your nominal vanilla bonds. If you look at cash, I mean, I've said cash is trash for a number of years. when the SARB started cutting rates aggressively in COVID, it really cut rates so much that there was actually no return potential in cash. But we've now seen, with obviously the SARB moving the other way and starting to hike interest rates, it's starting to become more and more attractive, especially in an environment from a risk-adjusted perspective. It's starting to look more in line with its longer averages. Let's look at what does it look like. I mean, if I look at some developed markets, the real bond yields available at the moment, you'll see they're big negative numbers. I mean, you should look at the US -5, the UK -7, Europe -7.5. And then you look at South African real bond yields, roughly around +3. One of the highest in the emerging world. Brazil is about +2, close to us. Mexico, barely positive. And then obviously the two strange ones at the moment, Russia, obviously because of the war and the sanctions, high inflation in that specific economy, and then even massive inflation, more than 50-60% inflation in Turkey gives us that negative real yields on their bonds. Even though the nominal bonds are much higher than ours, the real yield is obviously much lower because the inflation is 50-60%. Again, SA looks very attractive within relative to developed markets, but also within emerging markets. If we look at South Africa relative to its history, our real bond yield, you can see it oscillates roughly around 3 and a bit % is the long-term average for South African 10-year bond yields, in real terms. At the moment, we're at around 5% real, almost 1% one standard deviation on the high side, on the real yield side, which is attractive. So again, even relative to our own history, we also look attractive on a real yield bond basis. Let's talk about South African inflation linkers. Now, again, a good asset class to own. You've got defense against the high inflation at the moment. We just need to say that we need to realize that we think that inflation is likely to fall over the next 12 months or so. So that's the dark blue line. In that kind of environment, your break-evens are going to come down. So your relative performance to nominals is probably going to be less positive. Not saying that you don't want to own this asset class. We do like it. We want to be overweight, but we would prefer to be more overweight in our nominal bonds in an environment where inflation has already peaked in South Africa and will be coming down over the next 12 months. What about cash? I said cash was cash here. You can see here in the COVID scenario, we had real negative potential yields in the South African cash market. Money market didn't really give you anything interesting. So from an asset allocation perspective, we said, no, we wanted to stay away. But look now, with the SARB hiking rates, we're almost back to our long-term average on a real yield basis on cash. So cash looking much more attractive now for us relative to where we've come from over the last 2 years. From a relative valuation perspective, if you look at cash relative to bonds, relative to equity in South Africa, and we try and just invert the yields on cash and the yields on bonds to get us some sort of a PE on cash and bonds, and then to be able to compare that with equity. At the moment, equity, we have a trailing PE of 11 times in South African on the all share. You've got a trailing PE of 18 times on cash, you can see there. And then bonds, a trailing PE of 9. So again, nominal bonds in South Africa looking more attractive as a relative valuation play relative to cash and relative to equity at the moment. So again, no surprise that if you like the fundamentals, you think that the real yield story is there, so the valuation underpin is there, probably from a risk-reward perspective, very much a favorable underpin for nominal bonds. The last asset class I want to talk about is listed property. We have seen some operational improvements outside of office in the listed property sector in South Africa. Some of the vacancy rates have started improving. You've seen the rental reversions also improving. They remain, unfortunately, still negative predominantly. But the problem for listed property is, yes, it looks better than it has been over the last couple of years, but it's still not back at the levels of pre-COVID, 2019, when obviously the reversions were still much more positive at that stage, and you actually had much lower vacancies. Obviously, in a rising interest rate environment, also we worry a little bit about the interest costs that are becoming a financial worry for some of these listed property companies. The valuations look very attractive. I have to say that. I mean, valuation is a big positive underpin for this specific sector. Property values have stabilized, again, outside of the office sector. But the valuation is not the only thing that we need to look at. When we start looking at some of these fundamentals and saying, you know, watch out for interest rate costs, and some of the rental reversions, predominantly, they're still negative. You know, one has to be saying that your risk reward is not as favorable as just looking at the reward potential from very low valuations. Let's look at some of those operational kind of indicators. Just looking at the three main sectors, retail, office, and industrial. You'll see there that, you know, office, we've got little downward arrows in red showing that the vacancy rates are still moving the wrong way. They're going higher for office. We have rental reversions that are still going more negative for office. The net operating income still going the wrong way, going down. Property value is still going down in office. So office is not where you want to be if you want to play in this specific sector listed property in South Africa. Where you would rather want to be is in retail and industrial. You can see that there we're starting to see the green shoots. On the vacancy rate side, yes, vacancy rates are improving. So they've been coming down in the retail sector as well as in the industrial sector. The like-for-like sales in the retail sector started improving. Your net operating income for both industrials and for retail improving. Property values have started stabilizing and moving somewhat up. So again, for those retail and industrial companies in the listed property sector, much more favorable operating environment. Office, stay away still at this stage. But what worries us still for the overall sector is that we have an environment where the cost of debt is obviously a negative, because the cost of debt for these companies are going up as interest rates are going up. So that's an interest cost kind of fundamental that we need to be very careful about for this specific sector. If you look at the property sector valuations, again, for office, which is the blue line here on the left-hand side, still goes down. So the property sector valuations are just being marked down all the time. So again, it's like catching a falling knife. You don't want to really be in that specific sector. But what you can see for retail and industrial, retail in red here, it's starting to move up. And the industrial side is actually flatlining at the moment before it probably goes up in 2023. So the sector valuation is starting to look more interesting. We need to just bear in mind that there are still some risks out there for the sector. So even though the valuations look like a sure buy, when we put our risk hat on top of the potential return, we have to say that we probably want to be more on the neutral side for this specific asset class. When we put all of this stuff together and we come up with some ranges for returns, and again, I'm always skeptical when I put this up, and I'm always worried how clients will interpret this, because it's not as if we know exactly how the returns are going to pan out in the next 12 months. We don't know. But we try and give some ranges within a sort of a base case risk on, risk off kind of environment. So these are rough indications of what we think the returns could look like based on the fundamentals as well as the valuations of each of these asset classes. But as I said right at the beginning, more importantly for us when we construct portfolios is we then say, okay, these are our kind of risk return ranges, but what are the risks associated with each of these asset classes for the next 12 months? And that's then where we determine whether we want to be overweight and whether we want to be underweight the individual sectors. So it's not a case of we just overweight all the stuff that's on the right-hand side that gives you the potential highest returns and underweight everything on the left-hand side that gives you the lowest returns. It's a bit more complicated than that. We try and put a risk element on top of that as well. So for instance, SA property, we just talked about this. You might say, well, SA property gives you the kind of highest returns out there. Surely you want to be overweight that? Not necessarily, because of those factors that we still think are risk factors for the sector, even though the potential returns might be significant. We want to blend down our optimism somewhat on the valuation side by knowing that the fundamentals for the sector is not as rosy as it might seem. So therefore, if you look at these kind of boxes, the neutral boxes are all the blues. The overweight boxes are all the greens, and the underweight boxes are all the underweight sectors. So that's the red boxes are the underweight sectors. Again, so for listed property, we say, well, we like the valuation, but we're worried about the fundamentals, some of them, so we would rather want to be neutral in SA listed property. On SA bonds, we say we like the valuation, we like the real yields, but we don't think there's significant risk, so we want to be significantly overweight. That's our strong overweight in vanilla bonds. Inflation linkers, we'll also like the valuation, but we think it's probably going to underperform vanillas in an environment where inflation is starting to peak and roll over. So we want to be having not a massive overweight like in vanilla bonds, rather moderate overweight for inflation linkers. And then SA cash, we say, well, cash, no trash anymore. It is a good asset class to own in an environment where the real returns are starting to look decent. And we also, it's a bit of a risk aversion kind of play as an asset class. To give you 8% return with no risk is probably pretty decent, still give you 2.5% kind of real return. That's why we want to say slight overweight in SA cash. Then SA equity, I said, it's a great story from a valuation perspective, but we know that it's going to go down with global markets, which are still likely to be under pressure into 2023. It's probably going to then shoot the lights out latter part of 2023 and into 2024. But for the moment, we are going to be just neutral on SA equity. On global bonds, I said earlier, it's not the one that we don't want to own anymore, especially in an environment where there's likely to be more drawdowns in global equity. Global bonds starting to look more interesting. So we want to be neutral in global bonds, neutral in global cash, because it's not the TINA environment anymore. There are now nominal yield alternatives. So, we talked about TINA for a number of years. There is no alternative to equity. So you want it to be in equity. That's not the case anymore. It's now the TANIA environment where we say there are now nominal yield alternatives. So again, from that perspective, global cash and global bonds looking more interesting. Where we don't want to be in a drawdown kind of environment is global equities, because we think there are still some downside risks with QE going to QT, with earnings downside risk, the Fed not pivoting before probably middle to the latter part of next year, an environment where we want to be underweight DM equity and EM equity. So from a risk and a return perspective, that's how we want to position ourselves. Ali, I think that's where I want to stop, and I will open it for questions, and maybe you can let me know which questions there were from earlier.
Fantastic. Thank you so much, Herman. That was so insightful. We do have some questions. So the first question is from Chris. He would like to know, will cryptocurrencies become an asset class once they are taxed and certified?
Well, it's pretty obvious. I mean, that regulators are saying it's already becoming an asset class. I think, so yes, Chris, that will be the case. I mean, it's already in the regulators' framework that they are seeing it as an asset class now. Obviously the follow-on question for that is, how do asset managers, investment managers, then deal with the fact that you now have something that's been classified as an asset class, and we've had long discussions within Momentum Investments about this specific asset class, and the problem that we have is that we have no idea how to value this. So when this asset class goes from a specific, well, obviously there are more than one crypto. I mean, whatever crypto you're looking at, if that halves in price, we have no idea whether it's cheap or not. When it doubles in price, we also have no idea whether it's cheap or not. So from our perspective, I think there's a lot of work to be done to try and see what is going to be the main driving force as a fundamental for how to determine value. Because if it's just a guess, then that's not asset allocation, that's not portfolio construction, that's just gambling. And we will never use that as a tool in order to think that we can use this as an asset class. We need to know how to value this. Otherwise, we have no idea whether this asset class is cheap or expensive.
Correct, 100%. No, I can certainly attest to witnessing many a debate within Momentum Investments around cryptos, but there's definitely exciting times ahead to unpack it and understand it in more depth and as you said, in terms of valuation as well. So the next question is, you've touched on this. So there's definitely signs that inflation has topped out within South Africa. So we want to understand, how will this impact the South African asset classes, particularly pertaining to South African equities and South African bonds?
Yeah, very good question. I mean, and it does look like South Africa, that the South African inflation, global inflation as well, not global, really the US is at the front end, but we're talking specifically SA now. So for the SA asset classes, in an environment where inflation is peaked and probably coming off, that's good for nominal bonds. It's not as great for inflation linkers. So again, that's why we have that preference for nominals over inflation linkers. And obviously what it does as well is, because the SARB is not thinking about cutting rates as yet, it will probably, as inflation comes down, it increases the real return on cash as well. So it makes cash, I said cash is not trash anymore, but cash will become increasingly attractive as inflation comes down as well over the course of the next 12, 18 months. So I think from that perspective, it's an environment where you want to favor nominal bonds over inflation linkers, and cash is going to become increasingly attractive relative to inflation linkers. So at the moment, our preference is big overweight nominal bonds, moderate overweight inflation linkers, slight overweight cash. I think that slight overweight cash is going to increase and creep up over the course of the next 12 months, probably to a moderate overweight. And then inflation linkers is probably going to come down to more of a slight overweight over that time period. For equities, I didn't say. Equities, an environment, remember, for any equity, high inflation is relatively positive because there's pricing power. So companies can actually pass high inflation onto the consumers. The question is whether the consumer will take it or not, and whether it's going to have a demand impact or not. Inflation predominantly is a good story for equity. In SA equities perspective, obviously it's going to be less positive than if inflation peaks and comes off a little bit. But again, our biggest play in South Africa is really much the commodity side of it. So I think that, that's probably more important than inflation for equity. So I think inflation much more important for fixed income, for those three asset classes that I mentioned, than for equities. I think on the margin, maybe to a couple of decimal points, it might be negative for earnings for South African equity companies. But if you've got already, like we do, take a very conservative view on earnings and say it's not going to be the consensus 12, but it's going to be half of that 6 growth in the next 12 months, then we've already accounted for a lot of that margin of safety. So there's enough margin of safety for us in our SA equity numbers to still be positive about SA equity, even though in essence, it's probably marginally negative for earnings for SA equity companies.
Perfect. Thank you, Herman. Definitely tying into your view around the fact that we are overweight SA equities and SA nominal bonds. With that, Herman, I'd just like to say thank you so much for your insights. We really appreciate it. I'm just going to quickly tie in to the Momentum Investment Funds. But yes, thank you, Herman. We certainly appreciate all your time, and you just gave us so much food for thought.
It's my pleasure. Nice talking to you all.
Of course. Right. In terms of sharing, let me just share my screen. Okay, so as Herman mentioned, we are certainly optimistic in terms of the SA asset classes. And so in terms of our unit trust offering, I'd just like to highlight 2 funds in particular, the one being our Momentum Flexible Income Fund, as well as our Momentum Core Equity Fund. Right, in terms of our Momentum Flexible Income Fund, it is managed by Ian Scott, and it is certainly our flagship income fund that competes within the SA multi-asset income category. This fund is very unique because it's the best of blend in terms of our fixed income mandates, and it allows the management team to really access the best opportunities across the fixed income landscape that they believe will provide the best valuations. Because at the end of the day, the fixed income team headed up by Ian Scott is definitely founded in valuations. And again, you can see that coming through quite strongly in our discussions, or the discussion with Herman as well. In terms of the fund, again, due to its flexible mandates, it currently has a very aggressive stance towards long duration assets, given that it is just under 45% allocation to nominal bonds. And the fund, with a very aggressive objective being CPI +2, has done phenomenally well over the appropriate time horizon being 3 years, delivering around 7.35%, again, beating its benchmark, which is different to other multi-asset income funds in a sense that it is linked to inflation. So especially over this time that inflation has obviously increased, the fund is still managing to outperform its benchmark. Also, just something else to note, if you do access this fund on the Momentum Wealth platform, it also attracts the platform discounts. The next fund, as I mentioned, is part of our Smart Beta offering. So those of you who have been following our previous masterclasses would have a little bit more insight around our Smart Beta capability set. But for those of you who haven't, ultimately our Smart Beta funds combine the best of active and passive investing. It seeks outperformance similar to active funds, however, through a data-led approach, which then results in lower fees and lower costs within the portfolio. So again, this is the suite of Smart Beta funds, but the fund that I'd like to draw your attention to is the Momentum Core Equity Fund, which is managed by Jaco de Jager, and obviously the different style sleeves or funds are then managed by Lofty Botha. So in terms of the Core Equity Fund, this fund really goes by the phrase, the blend is your friend. So there are various factors that contribute to investment returns, particularly in equities. There are many, but the ones that are truly persistent and that we found to be persistent over time in our research, there are three. There is momentum risk premia, which we can also refer to as growth. There is value, and there is quality. And this fund actually blends between all those different styles in order to make sure that you're not timing the market on any one particular factor, and that you really have an holistic approach to approaching the SA equity markets. So once again, over a 3-year period, as well as a 5-year period, these funds do have a 5-year track record, consistently outperforming not only their benchmark, being the Cap Swiss All Share, but also outperforming peers within the SA Equity General category. Once again, just to highlight that SA General Equity can include many different types of investment approaches. You can have active fundamental value managers or passive managers. And again, the Smart Beta approach, really combining those best of both worlds and making sure that you achieve outperformance, but at much lower fees. Now, this fund also will attract the platform discounts or the discounts on your administration fees. And if you'd like to know any more information about either the Momentum Core Equity Fund or our flagship income fund, the Momentum Flexible Income Fund, please don't hesitate to contact me, the local fund specialist, or get in touch with your investment consultant, and they'll make sure that we can set up some time to take you through these funds. I just once again like to say thank you to Herman for his time. And of course, thank you to you, our audience, for watching. And we truly hope that we get to see you again at our next session. Thank you, everyone. Goodbye.
Goodbye.